Well, good morning, and thank you for joining PwC for our third annual Energy Visions Business Forum. My name is Cal Jacober, and I'm the Managing Partner for PwC in Calgary. I'm very pleased to welcome you to today's event. PwC's Energy Visions program was launched 2 years ago with the objective to provide leading commentary, publications, and events around issues affecting the Canadian energy sector. Many of you in this room will have seen our latest quarterly publication, Nothing to Fear, 5 Reasons Why Canada Should Welcome, Not Fear, Increased Foreign Investment in its oil sands and shale gas resources. Sounds very exciting. This year's topic is pipelines, politics, and price. Canada's oil and gas reserves are amongst the world's largest and most strategically important. As the industry expands production, and as challenges around takeaway and refining capacity increase, many are looking to government for a strategy to develop existing markets and to access new ones, particularly in Asia and the US. However, unlocking new markets presents an enormous array of policy challenges. PwC is pleased to present globally respected policy analysts and industry leaders who will discuss the issues and challenges around one of the most significant policy debates of our time, the opening of new markets for Canadian oil and gas. It's my pleasure to introduce PwC's new national energy leader, Mr. Reynold Tetzlaff. With more than 17 years' experience in a wide range of industries, Reynold has served as the Canadian Energy Services Leader for the past 2 years, and he's also a member of the Council for the Institute of Chartered Accountants of Alberta. He will be taking merger questions as well later on for the CACMAs. Not really, no. Okay, if you could please join me in welcoming Mr. Reynold Tetzlaff.
Thank you, Cal. I'd like to thank everybody for coming out this morning. We've got some really great speakers lined up, but before we get to them, I thought I'd quickly highlight some of the topics we'll be discussing this morning at quite a high level, and I think the speakers will get into a little bit more detail. As Cal said, Canada's got some of the largest and most strategic oil and gas reserves in the world. We're actually third in the world in oil reserves, and we're the third largest gas producing country in the world. Some of the recent activity that's led to the increased production as of late is some of the foreign funding. Really, this foreign investment has provided the funding required by some of these large-scale, capital-intensive oil sand plays to get them close to or at production. Another reason is, which was discussed last year, the horizontal drilling coupled with multi-stage fracking. It's really brought a lot of this tight oil and shale gas into production. And a lot of the unconventional oil and liquid-rich gas that's come into production as of late is a result of this technology. But this technology, while it's used in Canada to increase our production, has also been used in the US, and it's been increasing their production. The US production has historically been declining, but this technology has reversed that trend, and the production of oil and gas in the US has been increasing as of late. Couple this with the fact that US energy demand has been declining or flat on a year-over-year basis since 2007. That's not ideal for Canada since the US is our main customer. Add on to this fact, resource plays such as the Bakken play has added a lot of unanticipated crude into storage at Cushing, which is starting to stretch the capacity limits of this location. Cushing is also the pipeline and storage hub that Canada sends a lot of our oil and heavy oil to. The last count, there's 46 million barrels of oil and crude inventory at storage in Cushing. This causes some concern for Canada as well. So what does all this mean? Well, the US is our main customer. Their demand is flat. Their supply is increasing. They've got some capacity concerns. Canada, therefore, needs to get a little bit more serious about diversifying its customer base to countries where demand is on the rise. China, particularly for oil, Japan for gas, India, Korea. These country demand is expected to rise next year and into the future. So we need to consider how to develop stronger relations with these and other Asia-Pacific countries. And the first step is to have a stronger government-to-government relation with these countries. Another means to secure a strong relation with these countries, to secure global investor confidence, and to deal with some of the marketing and strategic issues Canada is facing, is the potential creation of a national energy strategy, which I think is now a Canadian energy strategy. I know there's varying views on this, and there's no consensus on what this would look like, how it would be structured, and who would be the driver behind these strategies. But all this said, there's some real reasons why global investors are currently investing in Canada. We've got low geological, geopolitical risk. We've got a great reputation around the world for contract transparency. We tend not to renegotiate our contracts. We've got world-class technology, and we have little exploration risk. Most of our reserves, oil and gas, are proven. A lot of it is proven. But these are the reasons these foreign investors are investing in Canada, but they're also getting a bit frustrated. They didn't invest in Canada solely so that Canada can continue to send oil and gas at a reduced world price into the US. What their expectations are is that Canada will be able to diversify its customer base and receive a true world price for our oil and gas. Their expectations are their demand is increasing. They don't have the supply. They're hoping that Canada can actually send them the supply. But because we're so landlocked, we actually haven't been able to meet these expectations. So what are these foreign investors doing? They're looking elsewhere. And they've got an opportunity elsewhere. If you look at the recent headlines, Japan seeks secure oil and has obtained secure oil supply from Saudi Arabia. China, they're building a refinery and the feedstocks coming from Venezuela. China is also looking at Colombia for a potential heavy oil source. They have other options. So we really need to get our infrastructure sorted out to capitalize on the world demand. Canada's focus in the past has always been sort of a north to south flow of crude, which has made a lot of sense considering the US is the largest consumer of energy, has been for years. And the strategy's worked out quite well, and Canada as a whole has done pretty good off of that strategy. But we need to focus elsewhere as well. The north-south flow focus will never end, but we need to look at other options. So we need to start looking at a flow from west to east to send some of the cheaper crude to the eastern refineries and take better advantage of the west coast so that we can diversify our markets and have more access to global prices. This isn't just an Alberta issue, this is really a Canadian issue. If I think about Canada and how quickly we were able to sort of come out of the recession, there's a lot of reasons. One is our banking industry is very strong, which we're all thankful for. Especially what's going on in the world today. Another one is the energy industry, the Canadian energy industry. This industry creates jobs, creates wealth, creates opportunity, creates taxes for Canada and all Canadians, and not just Alberta. And I really believe that. So now if we look at this industry and the fact that this Canadian energy industry cannot access the global markets, it's estimated we're losing about $18 billion a year for the fact that we can't sell our crude at world prices. That's $50 million a day. And that's really why we're here today. We're here to discuss infrastructure, we're here to discuss market strategies, and we're here to discuss the outlook of energy for Canada for the next year and for years to come. That said, I'd like to welcome everybody to the third annual PwC Energy Business Forum. And I'd like to introduce our speakers, which is probably why you're here today. I'm going to go through all the speakers, and then they're going to come up afterwards, and I'm going to read this so I don't actually get it wrong. Robert Johnson with the Eurasia Group is a fellow Canadian, specializing in oil, gas, power generation, metals and agricultural research, as well as client relations. He received his PhD in international relations from the American University in Washington, D.C. RJ will be addressing opportunities and risks for Canadian oil and gas. Our next presenter is David Goldwyn, president of Goldwyn Global Strategies, LLC. David served as the U.S. State Department Special Envoy and Coordinator for International Energy Affairs from 2009 to 2011, reporting directly to Secretary of State Hillary Clinton, where he conceived and developed the Global Shale Gas Initiative, the Energy Governance and Capacity Initiative, led ministerial-level energy dialogues with Angola, Canada, China, India, Iraq, Mexico, Nigeria, and Brazil. I'm not sure if there's any other country left. And he co-chaired a regional biofuel initiative with Brazil. David will present the 2013 outlook for U.S. and Canadian oil and gas. The third speaker is Erica Downs. She's at the John L. Thornton China Center at the Brookings Institution. Before joining Brookings, she served as an energy analyst at the Central Intelligence Agency. Erica has also worked as an analyst at the RAND Corporation and as a lecturer at the Foreign Affairs College in Beijing, China. She holds a PhD and an MA from Princeton University and a BS from Georgia University. As a specialist in China oil and gas market, Erica will be speaking about Chinese oil and gas investments in North America. Following the presentation, Steve Worry, President Liquids Pipeline from Enbridge, will join RJ, David, and Erica for a panel discussion followed by a Q&A session. That said, I'd like to invite RJ up to the stage. I guess.